G'day Internet, Max Wright here, and time for my, I do them kind of every year, every 6 months or so, a big update on the investing thesis about what's going on in the macro landscape. 50,000 foot view, what's going on. It's not a trading video, we're not looking at charts. This is something, I consider myself an investor, not a trader. It's more long-term positions that I take. And the question is, what am I doing now that's different from 6 months ago, 12 months ago? How is the world different? And we're going to look at all of that right now. So if that sounds fun, strap yourself in, hit that like button, say hello in the comments, and we will get into it. So let's see how I got over here. Okay. First thing, before we even start, I want you to have this frame in your mind as you go through all of this. The slide says, desperate governments do desperate things. Asset seizures, movement restrictions, price controls, banning Bitcoin mining, gold seizure, war. All of those things are on the table, in my opinion, we're going to go through 5 scenarios. In all scenarios except for the very first one, all of those things are on the cards in a big, big way, right? And so you need to think about just how volatile that looks. You need to think about personal security. You need to think about all of those things as we go through these 5 different scenarios. And then as we go through those 5 different scenarios, we'll elaborate on each one. Then we'll get to the end and kind of come up with some kind of way to take advantage of it, I guess would be the way to preserve your wealth and to grow your wealth. So I just wanted to get that note in there. In addition to thinking about your wealth, thinking about your personal safety, your personal freedom, those kinds of things, okay? They're going to be important to you. And I should do the boring disclaimer thing. All the usual disclaimers, not financial advice. I'm not a financial advisor, all that good stuff. You guys know how to think for yourselves, I'm sure. Okay, scenario 1. And this I think would put in the Cathie Wood scenario. Scenario 1 is balance. So think 2016, 2017, 2018, those kind of years. And what does it mean? It means MMT works. MMT, modern monetary theory, works. These guys have nailed it. The powers that be are doing their job. Now, it's not the job you think it is. The way they report it to you is they're reporting to you stability. And that's their job, and they pat themselves on the back when they get stability, and you feel like they get stability, and everyone's happy. That's not what they do. It's not what it's about. It's not even close to what it's about. What balance means to them is that inflationary forces and deflationary forces offset each other quite nicely to create relative stability for the lower classes, right? They just want to keep, what they figured out is that when you can't let the bottom of society get too low, go down too far, too quickly, or else they riot, they protest, they have their cake moments, they lynch the leaders. There's a revolution, all those kinds of things. And so their definition of that, what they want, what they've always wanted, is to extract as much wealth for themselves as possible. Now, we live in a world of incredible technological advancement, meaning every single year, the cost of production of things, the number of inputs, I don't mean the money, the number of inputs, the resources, the labor that needs to go into producing products and services goes down. That is a deflationary force. It should translate to a very, very, a massive increase in the standard of living for everybody. That's a deflationary force. All you need to do is your wages just stay the same because the cost of production is plummeting. When you go to the grocery store, things are much cheaper. Your quality of life increased. That's a deflationary force, right? What they figured out 50 years ago now is that they can print a whole bunch of money and confiscate all of that quality of life through inflation. Now, what they've always aspired to do is balance. What they want is that the inflationary forces of them printing, they want to do it at just the right level so that the deflationary forces that are caused by increased productivity, the net result is that, let's go down the spectrum to around about the 75th percentile of, blue collar worker in whatever country you're in. They want that person's life to stay the same. Maybe a little bit lower, maybe 80%. Their job is to stay the same. The quality of life for those people should be exploding because of the technological production. But what they want is for it to stay the same, and they'll just take all of the benefits of the technological advances they want to steal for themselves. And they have very, very effectively done that for the last half century. There's been little tiny booms and busts along the way, but nothing major, nothing Great Depression style, nothing, nothing crazy. There can be little booms and busts along the way, but the 7-year cycle, the 10-year cycle, that's okay. But they're just trying to ride that wave as much as possible, steal as much as they can, but don't steal so much so that you revolt. This is considered balance. It's when the inflationary and deflationary forces balance each other out nicely and life goes on, right? The consequence of this policy is that the wealth divide increases. However, there's no significant pain to the underclass, and protest that should be avoided. So you're keeping the punters happy, right? But you're still taking an ungodly amount of wealth, stealing it from the system without producing, right? These are the powers that be we're talking about. In these environments, investors move to risk-on environments. Things are okay, things are going cool, and we want risk-on type investing. We want tech stocks, we want a whole bunch of things. So in this environment, the strategy is to borrow US dollars, borrow as much as you can, buy Bitcoin, buy tech stock, buy income-producing assets to support even more debt. Cathie Wood's ETF ARK. Those kinds of things are going to go ballistic in this type of scenario. Okay? So let's leave that there. That's scenario number 1, balance. Okay, let's go to scenario number 2. High inflation continues. This would be, I guess, more the Peter Schiff scenario. Okay? In this one, government demonstrates no appetite to curb inflation. Right? A risk-on environment returns. Asset prices soar, as does the cost of living. The wealth divide worsens sharply. Okay, so in this high inflation scenario, right now, the government is threatening to raise interest rates to get on top of inflation. We are not here now. When inflation was transitory going back 6 months, 12 months, I think you could say that. Stock market was all-time high. I think Bitcoin hit just shy of 70K. It was a risk-on environment. Cathie Wood had just had the most epic 5 years of her life. Everything was looking really good. And then the inflation numbers start to come out and hit. And then the Fed has to talk a big game. They started talking about tapering. They started talking about raising interest rates. And we went away from this risk-on environment to, whoa, there's risk in the market. We got inflation. What are we going to do? Now, this scenario 2 is going to play out the scenario whereby, let's say we can just live through high inflation for quite some time. The government shows that they're not willing to be firm with inflation. So what that means is maybe they put interest rates up a little bit here or there, but they're not showing the appetite for doing what's necessary and really like going 1970s 20% interest rate. It wouldn't need to be 20% interest rate in this environment because we have so much more debt now than then. But I'm just talking about their appetite, their talk. What is their talk? Not even their talk, because they're always going to talk. They're going to try and spook the market into saying that they're going to conquer inflation. And right now, enough of the market are believing them that they're a little bit hesitant in the markets. That's a big risk factor at the moment, that they're going to put interest rates up 7-8 times over the next year, and so there's risk that they're in like this, a risk-off type situation. Forgetting what they say, the moment the market believes the Fed's all bite got no bark, you'll see asset prices soar again, because it becomes too expensive to sit on the sidelines and leave your wealth in cash. You have to go and put it in the market. You understand? The result of this high inflation is that the wealth divide worsens rapidly. Those with assets see their wealth soar because asset prices are going up for the reasons that I just said. However, in the lower classes, these guys don't have assets. All they see is their food bill, their rent bill, their gas bill, their utility bills. They go up massively. Their quality of life goes down. Their disposable income goes down. And eventually, you get an inflation-caused recession. Eventually. How far away is that? That's like a question. Now we get into a timing thing. But I guess this scenario 2 is where the government lets inflation run for another 6, 12, 18 months, right? And we don't see that recession yet. When the recession hits, that now you're in a big problem. The inflation-caused recession is a big problem. You've got this massive wealth divide. It can lead to civil war, protests, and if the government lets it run too long, you get into a situation of hyperinflation. Even the underclasses know they need to spend everything immediately because the money is devaluing too fast. That's what inflation means. The money is devaluing. It's losing purchasing power. And so all of these situations come about. Now remember what I said at the beginning here. From this scenario, scenario 2 through scenario 5, think about what desperate governments do. From here you might see price controls. You might see people fleeing to gold and silver. They're going to confiscate gold and silver like they've done in the past. They might try and outlaw cryptocurrency mining, Bitcoin mining. They can do all kinds of things. You need to be aware of these things in this scenario. So they're going to try all kinds of tactics to try and keep a lid on inflation, but not doing so such that it spooks markets so much. Can they do that for an extended period of time? Can they ride that wave good enough for 6 months, 12 months, 18 months? See, I guess like the scenario 1 is that they do that for 3, 4, 5, 6 years. Scenario 2 is they let inflation get out of control and you get these knock-on effects. They didn't find balance. They undershot how much the stimulus they were going to create, how much intervention they did, and inflation ran out of control. People believed their bite was less than their bark, and we went to a risk-on environment. And then you get this kind of scenario. If you knew with 100% certainty that we were going to go into scenario 2, what strategy would you employ? Well, in high inflation scenarios, obviously you would want to borrow as much money as you can. You borrow money and you buy anything that will go up in inflation, which is Bitcoin, gold, income producing assets, especially those resistant to the civil unrest that will come about in the next, when this high inflation comes to a head. High inflation can't go on forever. It has to come to a head. You either have to cause a deflationary spiral or you have to allow the currency to go to zero. But once inflation kicks on really hard, it is very, very, very hard to stop. Without either scenario is extraordinary amounts of pain. Okay, and sorry, the reason you want income producing asset is to support more loans. Okay, so that's what you would do in scenario 2, high inflation. And if they allow the inflation to run rampant, they can't talk you down. Okay, scenario 3, this is de-dollarization. Now this is, how do you want to talk about this? This one comes along very infrequently in history. So this is the kind of thing, so okay, a little bit of background. What does de-dollarization mean? At present, you have the United States dollar as the world's reserve currency. Okay, that's fun. What does that mean? It means that the whole world chooses to save in dollars, denominate their loans and a whole bunch of other things in dollars, and it's a store of value that the whole world trusts. Okay, as a result of this, 2/3 of all United States dollars are overseas. There's no other country's fiat currency that could espouse anything close to that. It's just used by the local community. But US dollars is used by a much, much, much broader range of institutions, people, etc. And so 2/3 of dollars are overseas. Now, let's see what this first bullet point is. De-dollarization basically means the end of the petrodollar world order. There's been several people talking about this. A guy named by the name of Zoltan something or other wrote an important article about it just the last few days. And he used to be a Federal Reserve. He used to be on the board there, I believe. Now he works at Credit Suisse. And he is saying that with what the response to Russia and the Russian-Ukraine thing is that the world will not tolerate it. So what was the response? Seizing Russian assets, confiscating wealth from Russian oligarchs, kicking them out of the SWIFT system. All of these things, the rest of the world is watching this. China especially, India especially, they're all watching this like, wait a minute, this is our wealth, this is our savings, this was sacrosanct. This is, you can't mess with this. Are you saying the moment that we do anything that the United States disagrees with, they're going to confiscate all of this wealth? This cannot stand. I'll give you another example. Switzerland remained neutral during World War II and allowed both Allies and Axis powers to use banking facilities there and store of wealth values and vaults there, etc. within 3 days of Russia invading Ukraine, they confiscated Russian wealth and employed sanctions and a whole bunch of other things, right? Hitler couldn't even get Switzerland to break the sanctity of that store of value situation that Switzerland offered. Putin went and did it, Russia did this, and all of a sudden, such is the cultural time, some 70, 80 years later, all of a sudden Switzerland's like, yeah, we don't give a damn about the sacrosanct of any of these things. And what that means is the whole world, China, India, Brazil, all like, wait a minute. I can see 5, 10, 15, 20, 25, 30 years down the road, somewhere, sometime, am I going to have a disagreement with the United States? And like, if I do, what are they going to do? Just take our money? Like, let's say there's just a million different scenarios where any one of those important countries can say, oh, you know, we disagree with the United States. And you want to be sovereign. You're your own nation. You have different hopes, dreams, and aspirations than the United States has. And every now and again, you're going to disagree. It doesn't mean you're mortal enemies, but it does mean you can disagree. And when they've got that leverage over you, that they can kick you out of the SWIFT system, confiscate your wealth, confiscate your citizens' wealth living in their country, all that kind of jazz, the whole world looks at that and goes, whoa, this is no bueno. We need to make moves now to de-dollarize. Saving our money in terms of your currency is too damn dangerous. And all of this stuff just accelerates the problem. Of course, a big part of the problem is the fact that the US dollar prints so much money. That's also, I mean, I'm saving in these dollars and you're printing it all the time, trillions of dollars a year the last few years, you're devaluing my savings. So this was already a huge issue. And this continued to come up. And I think it came to a head today or yesterday. When did it happen? Who was it? India, was it India and Russia started discussing paying for, India can get cheap Russian oil and gas if they buy in rubles, and they're entertaining that idea. China, similar kind of negotiations with Russia, things like that. This is huge. Actually, I'm sorry, it wasn't India, it was Saudi Arabia, which is the absolute core of the petrodollar. For those of you who don't recall how the petrodollar came about, 1971, America's war spending, Vietnam is too much, and what they had promised is that the gold window would be open. Any country can redeem their US dollars for ounces of gold. And a whole bunch of countries got together, led by France, and they said, okay, we see how much you're spending on the Vietnam War. We think you've printed a whole bunch of dollars. I'm thinking this isn't gonna work. And they effectively did a run on the bank. They did a run on the United States dollar, and they started demanding their gold. And they were right. The United States had produced all this paper money to do the Vietnam War. They didn't have enough gold, and Nixon had to close the gold window. At that point, that is a massive default. That is a default that should have destroyed the US dollar, save one thing. The whole world was rapidly industrializing. Oil was everything. Saudi Arabia, surrounded by its enemies, and one of the most oil-rich places in the world, the United States military went to them and said, hey, we have the biggest military in the world. We can protect you from all of your neighbors forever. We want you to do something. You can only accept payment for oil in United States dollars. If you do that, we will protect you for free. And it went to the petrodollar system. Every country in the world still needed to save dollars in order to buy oil from Saudi Arabia, and then eventually OPEC was created. The entire the oil markets and the commodity markets and all of those things were built upon dollars, and so nations' savings in dollars started having value again, and it delayed the inevitable. The petrodollar system was born. So when Saudi Arabia comes and says we're open to the idea of selling and trading oil with in rubles and stuff like that, I mean, this is crazy shit. This is like the end of the petrodollar system. So what does that mean? I really got to talk about this, because when we're investing or whatever and we're thinking about how the world works, it's just so much easier to understand and comprehend and give weight to things that have already happened in your lifetime. So, many of us lived through 2008. It's, that scenarios that we're going to get to in the future, which are kind of similar to 2008, it's really, really easy to understand that. I can remember it, right? But a de-dollarization event, or like a Bretton Woods system, like happened in that 1971 era that I was just talking about, or you go back, for other times in history when the British pound fell and the United States dollar became supreme. You go back before that, you've got the Dutch guilder. It's outside of our lifetimes. Within our lifetimes, there's certain things. There was like a board, like a game board, a chess board, call it whatever you want. And we're looking at, when we're looking at what to invest in, you might be looking at interest rates, and you're looking at, unemployment numbers, and that's like looking at all the pawns on the board, and you assess it, you make your investment decisions, and you understand that, and you have a normalcy bias that the board is the board, and the board's not going to move. But the board does move just once a lifetime, or once every 5 lifetimes, or something. But our normalcy bias never ever weights that appropriately. Because when someone comes in and flips the board over, then, understanding where the pawn is and the bishop and the interest rates and the unemployment, it's all completely irrelevant. The board just got flipped over. A de-dollarization event is the board getting flipped over. And we all have a normalcy bias that can't happen, because it's all we've ever known in our lifetime. But it absolutely can happen. It happens many, many times throughout history. It just actually happens in cycles. Coincidentally enough, we are upon one of those cycles. It's an 80-year cycle. Well, it's a combination of a few different cycles. But yeah, so the Bretton Woods system, it came about in the 70s. Prior to that, there was during the time of the Great Depression, there was a new monetary order. You go back, it's about 40 years is the monetary cycle. We're late. This one from 71 to 22. This one's gone 50 years. We're overdue a new monetary order. So I just wanted to bring your attention to your normalcy bias, my normalcy bias. These things happen. They just haven't happened in our lifetime, and it's hard for us to attribute some weight to them. Okay, the United States dollar goes down. So in a de-dollarization event, what that means is the value of the United States dollar goes down. Now, here's why the de-dollarization event is a little bit unique to Americans. Pretty much everything else, I think, doesn't matter if I'm talking to an American or someone from Australia, England, somewhere in the West, doesn't matter. It's all the same. De-dollarization is the only thing that affects US so much more than everybody else. All right? Of the 5 scenarios, this one is very, very unique to America. And what happens is all of those dollars, remember I said 2/3 of the United States dollars are actually overseas? Well, all of a sudden, no one needs or wants them anymore. Now, the American citizens do, because the government will come and put you in jail if you don't pay your taxes in dollars. So, but the rest of the world, they don't need them. We can do our savings in gold and Bitcoin and rubles and yen and renminbi and special drawing rights. We can do a whole bunch of other things. And the appetite for dollars plummets, and all those dollars overseas start to come home, slowly at first, very, very quickly at the end. What that is the United States gets flooded with dollars. Just simple math, if 2/3 of the dollars are overseas and those dollars comes in, what that means is the money supply inside of the United States triples in a relatively short amount of time. The consequence of that is a plummeting in the standard of living for dollars, right? We can't buy, the cost of imports soars because our currency is worth less and less. These dollars are coming in, so people don't want dollars anymore, and I don't really want to be exposed to America, but I mean, if I've got dollars, and rather than sticking in a bank in America, I'll buy assets. Maybe I'll buy Facebook. That's a fun asset. That's an asset with worldwide appeal that's on the American stock market. Maybe I'll go and buy that asset. Florida is still a beautiful and amazing place to live. Maybe I'll go and buy a beach house in Palm Springs, or maybe I'll go and buy an island in Key West or whatever. As those dollars come in, asset prices soar, because I don't want dollars and I don't really want to be exposed to America, but okay, I am. I've got these dollars. I've got to do something with them. I want to buy businesses, American businesses that are worldwide. I want to buy premier pieces of real estate, which are still great places to live. Everything else, you're in trouble. You're in trouble, right? So the value of the dollar goes down. You get very, very, very high inflation in the United States. The cost of all imports skyrockets, right? And you get a flight of capital. There's a worldwide flight of capital to safe havens, right? Because they've lost, the US dollar was the world's reserve currency. It's the major safe haven. and it all of a sudden looks shaky, and there's a flight to safe havens. Now, lots of different people, entities, sovereigns, businesses, they have a different definition of safe havens, right? For some, it's gold. For some, it's Bitcoin. For some, it's foreign assets, right? For some, it'll be the renminbi, maybe. Maybe. Do you trust China? I certainly don't. I don't think many people will. Special drawing rights, that's the United Nations plan for a one world currency. So it's the currency they've got waiting in the wings for just something like this. Or maybe it's a currency basket idea, and they have a Bretton Woods environment. They all come down and sit together, and how are we going to manage this? And they say, well, okay, US dollar, you abused your privilege as a world reserve currency. So now we're going to have another world reserve currency, and it'll be a basket of currencies. It'll be 20% pound, 20% Chinese renminbi, 20% Swiss, 20% US dollars. Maybe you have to let Russia in on something like that. Who knows? There could be a currency basket at the end of it. So, okay, in that scenario, if you knew 100% with 100% certainty that de-dollarization was happening tomorrow, what's the strategy? How do you take advantage of that? Well, the answer is you borrow US dollars like as much and as far as you can, and you buy the safe haven assets I just mentioned: gold, Bitcoin, foreign assets. This is kind of this is like a Peter Schiff fund type thing as well. He's big on foreign assets and gold, except for, of course, the Bitcoin. He's super anti-Bitcoin. But so this scenario, this de-dollarization, this is kind of a Peter Schiff scenario, right? And again, why would you borrow US dollars? Because the value of dollars is plummeting, which means you borrow the dollars, you buy assets, those assets soar. You can buy Facebook stock, Florida real estate, Bitcoin, gold. The value of that soars as the whole world sells their dollars and buys that stuff. Then you can sell 5-10% of the new assets and pay back your entire loan, because those assets, they went up a lot and the US dollar went down a lot, and it was a tremendous arbitrage. So that is how to play scenario 3. Of course, there'll be a conclusion at the end. We'll tie this all in together, see if we can get some overlap. Scenario 4. Now, this is a de-leveraging event followed by money printing. Now, this should be the one that you are most familiar with. Why? It's 2008. Even better still, it's COVID 2020. All right? Now, the de-leveraging event doesn't really matter what it is. There's so many things that it could be. There can be the demographic cliff that, all the retirees, the boomers, they head into retirement, and they realize they haven't got enough money. They start to doubt the pension system, and they don't think they've got enough to live off their in retirement years, and they just stop spending big time. Demand plummets, goes into a recession. That's one scenario. High interest rates to break inflation. That's what they're threatening to do right now, isn't it? Absolutely, that can be something that can cause this deleveraging event. A pandemic, again, we're really familiar with this one. This was the most recent one. I don't need to tell you about COVID, right? All the market, Bitcoin down 50%, stock markets down 30% all over the world plus, all within a couple of weeks. It was a monster event, a massive deleveraging event. Things that we haven't seen so much: cyber attack, war, and I've got the Iceland stock market crash just in there as a tongue-in-cheek one to make fun that, remember 2008, that whole housing crisis of 2008? That bubble was pricked by the stock market in Iceland collapsing, right? And then, of course, you've got bank failures. Keep an eye out for these. Deutsche Bank is one that I've been talking about for a few years. It looks shaky to me, but there could be bank failure. I mean, there was almost a bank run in Canada, a month or two ago, when Trudeau says, we're gonna just take people's bank accounts if you protest us, and not just say it. He did it. And there are so many people in Canada who are like, oh, well, they were bad guys, those truckers. You got to do what you got to do. No, idiot. It's anyone he disagrees with, which means it can be you next week. So this deleveraging event it can be a million things, right? There's just so many different ways that this can come about. Because right now we are in like one of the biggest bubbles that the world's ever seen. It's an everything bubble, and it's across the whole world. So these deleveraging events are big, and so many things can prick that bubble. In this scenario, all assets suffer: gold, Bitcoin, stock market, real estate, and especially foreign assets. Why? Because there is a flight. The initial response is a flight to US dollars, treasury bills. Now, this is kind of in line with Brent Johnson's dollar milkshake theory, right? When a deleveraging event happens, the first place, and it can be a relatively short-lived period of time, but the first thing that happens is United States dollar goes up. Why? Because you're selling your foreign assets, you're selling your gold, you're selling your Bitcoin, you're selling your stock market. It is plummeting, and you're just getting out and getting into dollars. Let's put it in some AAA T-bills, and our balance sheet looks good. And as a result, the United States dollar skyrockets. But it can be a potentially short-lived situation, because in almost every single one of these deleveraging events that we went through, demographic clip, high interest rates, pandemic, cyber attack, war, etc., in every single one of these scenarios, the most likely outcome, in my opinion, is that the government will print its face off, just like it did to COVID, right? And they print and they print and they print and they print. What does the world see? The world sees this, it's like, whoa, maybe United States dollars and T-bills are not as good as we think. And you get this explosion in precious metals, Bitcoin, and all of the other things that originally suffered, right? Just this one's really, really easy for you guys to understand and experience, because we all went through it a couple of years ago. If you were paying attention to markets, you know what happened. Everything gets hit and crushed, and then this Fed says, we're not going to tolerate this nonsense. They start printing, and all of a sudden, don't fight the Fed is the meme, and you just buy up everything in sight. Everything goes up. Bitcoin exploded, went from 10 grand to 60 grand shortly after this. Just crazy, crazy stuff, right? But you know this one very, very well. Okay. The event provides policymakers with the excuse to print like crazy. All assets rise, and inflation runs out of control. Okay, you know all this inside and out. You've lived it the last 2 years. If you knew with 100% certainty that scenario 4 is going to be the next big event to hit the world, what do? Well, if you knew what was happening in the first phase, you would wait on the sidelines with the United States dollars. Then you would borrow. Then in phase 2, you would borrow as much as you can. You would buy gold, Bitcoin, stock market, and real estate. Okay. If you knew, just think about if you knew the dates of COVID-19, when the government's going to lose their mind and put everyone into lockdown, and if you could have sat on the sidelines and not got wiped out 30% in the stock market, 50% in Bitcoin, and could you just wait, and then jump in? Silver went from $12 to $24 in the space of a couple of weeks. Bitcoin went down to like 3 grand, came back up to, took a little bit to get up to like 6 grand, 10 grand, flirted with 10 grand for a few months, and then went ballistic, went to 60 grand. Yeah, it went from 3 grand to 60 grand, like that. If you knew the dates of when all these things were going to happen. Stock market came back quickly, and then real estate took a little bit. It also didn't get hurt as much, but then it came back absolutely on fire the last 12 months. So if you knew that this was going to happen and you knew the dates of everything, it would be perfect. But the way to play this one, you wait on the sidelines with cash, then you come in, you borrow as much as you can, and you buy all of those assets. And then finally, there is scenario 5, which is a deleveraging event followed by austerity. Now, this one is what's his name? Harry Dent. This is your Harry Dent scenario. It's basically exactly the same as scenario 4, except the government says, this beat us. We can't spend and drop interest rates. We can't do it, right? Because inflation's out of control, and we have to let the market suffer, and we are going into austerity. Okay, so it's just the deleveraging event with no money printing, or maybe the more accurate term is unsuccessful money printing. It just doesn't work to goose the economy enough to bring back that demand. Okay? Now, this one, think about the Great Depression. There are years of downtrend, right? The market goes down for years. Things are very different to the last scenario. Last scenario, that we went down for a couple of months, money printing, roaring back. This one, you go down for years and years and years, and it can take decades to recover the losses, right? Now, the strategy, if you knew with complete certainty that that this was going to be the scenario, what would you do? You would be in cash, you would be in treasury bills for phase one, and then you would buy real estate, dividend paying stocks, you would buy Bitcoin. But by the way, this is one of the weaker scenarios for Bitcoin, because with the austerity, the government's saying, so we're not printing. We're not going to print in any meaningful way. And so the assets just go down by a lot. But now, so I want to be clear about this. Being in cash and T-bills for phase one, and then buy all those things. And in this scenario, Harry Dent looks like a genius because it's exactly what he's predicting. But here's what I want to say. The being in cash and T-bills for phase one, but remember, phase one can be 4 years, 6 years, 8 years, 10 years. Scenario 4 is the exact same methodology. You be in treasury bills, you wait, you have the crash, you jump in, but you jump in 3 months later, 6 months later, 12 months later, because it's so short-lived, because the money printing was successful. Okay? So these are the 5 scenarios that I see playing out. Let's tie all this up into a little bit of a conclusion here and see what we can get to. Oh, this is just pointing out, it's the time scale that makes these last 2 scenarios different, right? They're both down, then up. One stretched out over a couple of years, one stretched out over a couple of decades. Okay, a word before the conclusion. I put this slide in for myself, but I didn't remind myself what the word was. Oh yeah, I remember. Don't try and be a Nostradamus and pick one of these scenarios. I'm convinced it's this, and then only be okay in that scenario. There are so many things going on. This is so confusing. There's so many intertwining things going on, and no one knows for certainty what's about to happen. So I highly recommend that whatever strategy you develop, you make sure you're going to be okay in all scenarios. All right, make sure that you are going to be okay in all scenarios. Don't leave yourself, don't bet the farm on any one scenario, because there's nothing completely certain here. Okay, and probably another a second word before the conclusion is, I want to go back to that early slide, that first slide, which is desperate governments do desperate things. And you need to think about your personal safety. You need to think about owning assets that are difficult to confiscate, right? Having all your wealth in one continent, having all your wealth in one country, I think is a particularly bad idea. Making sure you're fit, making sure you're healthy, making sure you have reserves of food and things that you might need. These are all good. These make you powerful. These make you strong, because I'm very, very concerned in 4 of those scenarios, and I don't know exactly which one, but between all 4 of them, I think probably they add up to a more likely than not scenario that one of them is going to happen, that where governments get very, very desperate, and you need to be very, very resilient in those scenarios. Okay. Okay, I just had to take a little bit of a break there. I've got allergies kicking in. I had to spend 5 minutes scratching my eyes and face and nose. But we're back. All right, let's get to the conclusion. And these numbers, look, who knows? No one knows what's going to happen. I don't know. I'm just going to put some numbers to things. Let's get scenario 1. And this is balance. It's the Cathie Wood scenario, where the inflationary forces and deflationary forces are kind of neat and offset each other quite nicely. I give it about a 20% chance of happening. 20%. Okay. Scenario 2. High inflation. You borrow US dollars and you buy Bitcoin. Oh, sorry, let's do that. So in both of these scenarios, and in fact the next one, I think they're all the same. So what do? High inflation, I'm giving that a 20% chance as well. You borrow US dollars in both of these scenarios and you buy similar things. Bitcoin, income producing assets, whatever. Gold's not going to do very well in the first one, but so be it. Okay, de-dollarization. This is scenario 3. I'm giving this about a 20% chance of occurring of all the scenarios, right? Same story. You borrow US dollars, you buy Bitcoin, gold, foreign assets in this case. They're switching out foreign assets for gold, things like that. But Bitcoin and borrowing US dollars and buying Bitcoin and income producing assets, and all 3 of these things, good stuff. All right, scenario 4. This is the deleveraging event with QE, i.e. with printing, with money printing. And this one I'm going to give a 30% chance. I think it's probably the most likely of all the scenarios. So you get the strategy is that you be in cash and T-bills for phase one, things crash, and then you jump in and basically do the same thing as sections 1, 2, and 3. Right? Now that's pretty telling because we're up to about 90% here. Let me just do the last one. It's obviously 10%. This is the Harry Dent scenario. This is deleveraging and QE is unsuccessful. And in that scenario, you want to be in cash and T-bills for the phase one, and then after many, many years, you come in and you buy real estate, dividend-paying stock, Bitcoin, etc. And by the way, that's section 5. That Bitcoin's pretty weak in that scenario too. So I think there was 2 areas where Bitcoin can be weak. This is probably the weakest of all, because well, for a whole bunch of reasons for Bitcoin. But I know you guys are especially interested in Bitcoin, so I wanted to just point that out specifically for that. Okay, so how do you think about this? Well, one, the advice is make sure you're going to be okay in all of these. And you can basically, right now today, there's just 2 things you can do. Like you just do 2 things with a portion of your portfolio and you're covered for all of these 5 scenarios. What are the 2 things? You have some portion in cash on the sidelines waiting for scenario 4 or 5 to occur. And you have some other portion in Bitcoin or maybe income producing assets in for scenarios 1, 2, and 3 to occur. And if you do that, you're going to be fine. You've got enough cash to help you survive for a long time. And by the way, I will point out something. With section 5, this is a deleveraging without QE. It's the one that's similar to the Great Depression. Absolute fortunes were made in the Great Depression by people who didn't cry in their Cheerios. It's a very heartless way to say it. I mean, it took a lot of skill, it took a lot of hard work, but it took a lot of courage. And you guys have probably seen other presentations of mine. I talk about the Hilton Hotel dynasty starting in the Great Depression. When these things crash and go down for years and years and years and years and years, you can buy assets for pennies on the dollar. And in actual fact, the cash flow on these assets is ridiculously high. I think in section 5, you could leave me without a penny, not a penny to my name. As long as I had a good psychology and I had a roof over my head and food in my belly, I could go out and create incredible wealth in this period. Because assets are pennies on the dollar and it just needs skill to come in and make the deal work. You find ways to borrow money from someone somewhere who has it. It needs skill to make it work. And so as scary as this one is, this one 5 is just like misery for decades. It doesn't have to be you. Oh, very, very important to understand that. It doesn't have to be you. There are ways out of it. It's a little bit more of an active role. Okay? And you don't need much. You just have a little bit of cash on the sideline as you go into this and preserve your wealth. Let everything get smashed. And then you can come in with a little bit of capital. You'll be able to do a lot. So scenario 5 is, I'd say, the scariest of all of them. It's the one that makes you want to sell everything, get everything out of the market, go Harry Dent, and just be completely out of everything. Right. But it's not as scary as it should be, because at least for me, I'm confident I can make wealth even in that scenario. As long as I make it easy for myself and have, a good, healthy cash reserve there for me. So I know that one doesn't scare me too much, and I know I can make up for any shortfalls from that one with skill and energy and hard work. Okay, scenario 4, the pain is so short-lived that, again, it doesn't scare me. In that scenario, we just went through it. This is the one that was similar to the COVID pandemic. Now, again, I don't mean to be callous here and I don't mean to be insensitive. I know for a lot of people, they were destroyed. Small business owners, you owned a gym, a restaurant, or what, I mean, you just got absolutely crushed. So I apologize if I sound desensitized to that. But me and my world and my skill set and my investing, for everybody with regards to their assets, I mean, not if 100% of your asset is in the corner store that you own. Not then. You got wiped out. That's tragic. But for people who were invested in Netflix and Facebook, or people who own significant amount of real estate, or people who are in Bitcoin, or people who are in so many different assets, the pain was so short-lived. Things went down for 3 months, 6 months, 12 months, 18 months, and then everything else set new time highs. So that is not a particularly scary scenario. You just need enough money to survive for a year or two, as long as the majority of your wealth is not in one of those things that got decimated, like a small business. And as long as you can survive, the pain is very, very minimal for you there too. And then 1, 2, and 3, you want to just borrow a whole bunch of money and go and buy cool assets. Bitcoin, income producing assets. See, I like Bitcoin because it's all 3 of those scenarios are ridiculously good. In a world of de-dollarization, Bitcoin goes absolutely parabolic. In a world of high inflation, Bitcoin goes absolutely parabolic. In a balanced world, it's like 2014, 15, 16, 17, 18, we already know Bitcoin goes up 1,000,000%, right? There's 3 scenarios there where owning Bitcoin is absolutely epic. There's a couple where owning gold is good. There's some where income producing assets in America is fantastic. There's another one where income producing assets in foreign nations is even better. But for 1, 2, 3, and 4, Bitcoin is awesome. With 4, you might have to wait 3, 6, 12 months, right? And Bitcoin is awesome. With 3 of them, borrowing money, with 1 out of the top 4, Bitcoin, for 3 of them, borrowing money and buying Bitcoin is good. And one of them there, the deleveraging with the QE, you would just love to have the wisdom to be able to wait. So I went through all this exercise. I do this for myself kind of every year, and sometimes twice a year. And it's like, okay, what do I need to do? What do I need to shuffle around? Where in my portfolio do I need to move? And for me, it's turned out it's been pretty similar. I don't have to do too much, all right? I have a significant amount of wealth in Bitcoin. I have a good chunk of wealth sitting in cash. And they're the 2 places I want to be. They're the best 2 scenarios. I have other things. I have real estate. I have precious metals. I have precious metals in several continents. I could see, once you factor in the desperate governments do desperate things, I got to factor in, you got to leave your home and never come back. Well, having a huge chunk of value in your home is stupid. You might lose it. Ask a Ukrainian. So having a whole chunk of having precious metals in a vault in somewhere, well, that's a huge risk because you might be able to have to leave that continent and never come back. Bitcoin's ability to just, with gold and silver, I have to split my gold and silver up over several continents, and I accept in several of these scenarios, I lose a portion, right? It's in some district or area or continent or whatever that I can just never go to. I have to accept that that's a risk. With Bitcoin, I can take 100% of it all around with me. In fact, I don't even need to take it with me. I've already got places and private keys all over the world where, if I put 2 or 3 of those keys together, I can get my crypto, all my crypto. I get 100% of my wealth. I didn't have to give it some geographical, mitigation strategy, risk mitigation strategy. I can take 100% of it. You combine that with the fact that in so many of these scenarios it goes well, I want to be in a majority of Bitcoin. It's where I am. Cool. I don't need to do too much else. I don't have a lot of debt. Looking at this, maybe I need to borrow even more money. Because in a lot of these scenarios, having debt is really, really good in a lot of these scenarios. So maybe I need to consider having more debt, but never to the point to where I become weak, where I become not diamond hands, where I get myself into a vulnerable position whereby I buy, the purpose of them is borrowing the money. You can borrow the money, keep a little bit in cash for scenarios 4 and 5, borrow the money in Bitcoin, and if that Bitcoin gets destroyed or whatever, in the vast majority of scenarios, Bitcoin wins. In one of the scenarios where it loses for a very short amount of time, then it's back. As long as I can deal with all of those servicing costs, I can live with that. So yeah, there's only 2 asset classes that you need to be in my opinion, right now: cash, T-bills, and crypto. Everything else is inferior. And so you just need to now. Also, if you want to, add a little bit of debt. And again, I haven't said this, I'm saying it again, I've said it in previous videos, but not this video. You have to be mindful of who I'm talking to. Like, we're just so many different situations. If you have a high net worth, then these are the kinds of things you can think about. And you want to make sure that you're okay in all these different scenarios. If I was a young guy, 20 years old, and I only had 20 grand in my name or something like that, I'm not dicking around with, trying to manage all this situation and like, oh, I have 2 grand here and 2 grand here and 2 grand here. I'm not doing that. That's not what I'm doing. What I'm doing is I'm putting all my chips on the table on one of these. I'm not going to say which one. I think you guys can probably figure out which one. But if I'm a 20-year-old, I'm doing that. Actually, somebody else did this. It's quite in Bitcoin circles, it's pretty common. Sorry, it's a famous anecdote. And who's his name? So Will Clement and his buddy Dylan, and I don't know if they were buddies beforehand or met afterwards, but these guys basically did. They were just like a bunch of uni kids, student kids, college kids. They went and borrowed a whole bunch of money, personal loans, credit cards, whatever they could find. Bought a whole bunch of Bitcoin after the pandemic, after the COVID hit in 2020, and the Bitcoin went up 10x, and they're all rich now. Paid off all the loans, and now they're just crypto rich. If I'm like a young kid, like I'm doing that, and if I lose it all, so be it. I got to get to work and I've just got to start again. But that's what I'm doing if I'm a kid. I'm a high net worth individual. I have to manage shit. I don't ever want to have nothing. If I've got near nothing, I'll bet it all. If I've got a lot, I got to spread it around a little bit. So you got to play your hand the way that you need to play it. Okay, risk mitigation strategies. It's going to be different for different kinds of people, different risk appetites. So anyway, I think most importantly, you guys understand the thoughts going through my head, what I'm thinking here, why I'm thinking it, and you might think, Max, seriously, 20, 20, 20, like, come on, that's just stupid. One of those should be 0.1. You might have a totally different opinion on these numbers. That's totally fine. But I think walking you through this framework is going to be really, really helpful for you to design your own strategy here. And I would say make sure you're going to be okay in every scenario, and then maybe with some portion of your wealth, you put a bet on one of what you think is what maybe the more high likely outcomes. And especially if you can cluster them together, and if you agree with my assessments on how to play those scenarios, then you might start noticing things like, oh wow, Bitcoin's outstanding in 3 of them, tolerable in 1 because it gets hurt and then comes back, and pretty sad and pathetic for many, many years with scenario 5. You might start, and now you can cohesively come up with a plan that is palatable for you, your family, and everything else. So guys, that's it. This is a really, really important episode. I hope you guys liked it. It's taken years to come up with the knowledge to do it, but sat down for a couple of days to do the PowerPoint and kind of put all the things together. I really hope you like it. Hit that like button. Do me a favor, in the comments below, which one of these numbers here do you think I'm way off on? Is one of these is 90% certain in your opinion? Like if I'm talking to Harry Dent, he's like, your scenario 5, 10% is idiotic. Make it 90% and we can talk. Kathy Wood, she's saying scenario 1, it's a lock, go for it. Peter Schiff, he's like high inflation / de-dollarization. He's like one of those 2 for sure. And the deleveraging with QE, who's that? I can't think of anyone specific would be that. Oh, you know who I would say would do that? Mike Maloney. I would say Mike Maloney would be deleveraging with QE, I should say. So let me know in the comments below, which scenario do you think is the most likely? And as a result of watching this presentation, how will you change your portfolio? Okay guys, take care and I'll speak to you soon.